But we also have to be aware that all of our Middle Eastern currencies are in some way pegged to another currency or a basket of currencies of their trading partners. Again, we're doing this because we know as professional traders that it doesn't matter how big a country is, how big a currency is. It's really what matters is really the volatility of the asset itself. So when we move into Asia, we see that we have a large list again of emerging currencies in Asia, and a whole bunch of them have got dependency on commodities. And we also have a few of them, so the Chinese yuan, the Hong Kong dollar, and the Singapore dollar. These currencies are pegged regimes similar to GCC, and pegged regimes do have different nuances. We're going to look at those in more detail in video number 2. When we go into emerging currencies in Latin America, we can see that all Latin American currencies have some sort of dependency on commodities. And what we also notice is that there's no P's here next to our letter C's. So they're commodity dependent, but they're not pegged. They're actually floating. So when you go through the list here, you'll be able to see that anything that doesn't have a P is actually a floating regime. And anything that does have a P is a pegged regime. Now, as professional traders, we've mentioned or briefly skimmed over this, that as professional traders, what really matters to us is volatility. So when we define currencies, we don't really care that a country is in the G10 or not. Why would we care? As traders, what we're seeking out is volatility. So I want you to imagine, for example, a time horizon, and the time horizon can be any day, any time horizon at all. So it can be 1 day, 1 week, 1 month, 3 months, 1 year. And I want you to imagine just any asset. It can be currencies, stocks, commodities, bonds. It can also be bricks. So bricks are used to build houses. Bricks have a price on the open market, and manufacturers and wholesalers, distributors, developers, they buy and sell bricks in the open markets. They buy and sell bricks with each other. Bricks have a price like any other asset, and every asset has a marketplace. And over any given time horizon, what really matters for the people trading these assets is the volatility of the assets. And if we just pick 1 day, for example, as our time horizon, and we pick a currency, so let's pick a random currency pair, for example, like the euro US dollar, and say, okay, over 1 day, we're going to buy and sell this currency, the euro dollar, over 1 day, we're going to trade it 10 times. And we're going to look at the daily volatility of euro dollar. And let's say we find that the euro dollar over a 24-hour period just doesn't move. Well, it means that when we buy and sell it, we're buying and selling it at the same price if it doesn't move. And if we're paying a broker a commission every time we trade, so a spread, and it can be a very small spread, it doesn't really matter. But if, in theory, the price is the same over a 24-hour period, and we buy and sell it 10 times and pay to do so, it means that we're not going to make any money. In fact, we're just going to lose money. However, if we do have volatility, then an opportunity and risk is created. As professional traders, that's what we care about. We don't care that something's in the G10. We don't care that it's in Latin America. What we care about is what the currency's regime is and what the currency is dependent on. And this is a driver for volatility. So instead of organizing and segmenting currencies by geography and transaction size, we organize currencies by the potential opportunity. And the way we do this in the first step, and there are further steps that we go through later in the video series, but the way we do this in the first step is to segment into 4 main categories, which are ex-commodity floating, ex-commodity pegged, commodity floating, and commodity pegged. So what we're doing is we're filtering here by currency regime and commodity exposure. So the ex-commodity grouping here are currencies that are not dependent on 1 or 2 commodities in their exports. And these split up into floating and pegged regimes. Then we have the commodity floating and pegged, which are countries that are split up by or filtered by their dependency on 1 or 2 commodities and then by their regime. And if you go into the download section of the video series, so under video number 1, you'll see a download button. You'll be able to download the spreadsheet, which segments everything for you. And if you download that spreadsheet, have a look through it. Just familiarize yourself with it, because it's important to start getting familiar with these definitions, because we build on these things later in the video series. And the Forex markets organized sheet, we have the breakdown in the presentation. So if you just download it, you can familiarize yourself with it in your own time. So back to this point, what's more important is that we need to start looking and understanding how we capture and segment volatility, rather than segmenting by geography and size of transactions. Floating and pegged regimes and commodity dependency is the main way we do it. And what you've got to start thinking about is how countries, the value of their currency, how a country's value of currency depends on factors outside the country itself. So the phrase we use here is exogenous factors. So exogenous factors are factors that affect the value of a currency, but they are outside the control of central authorities within the country. So for example, if you're a country that depends very heavily on one trading partner on the other side of the world, but that trading partner has a difficult time in their economy, that is going to have an effect on your currency as a country, whether you like it or not. It's an exogenous or exogenous factor that is affecting the value of your currency. It's out of your control. Now, these are very important to professional traders, because this is one of the drivers of volatility. And that's why we segment by commodity and by regime. Now, we've put the results here of our breakdown from the Forex Markets Organized sheet. And the first thing we look at is the ex-commodity floating currencies. And what we find is we break down, first of all, by developed float. So what do we mean by that? We mean developed economies that have floating regimes that are not dependent on commodities. Then we have the EMEA floating currencies that are ex-commodity, the Asia-Pacific floating that are ex-commodity, and the LATAM. And you can see there's no Latin America there. The next definition is the ex-commodity pegged regimes. So we have Denmark in here. Denmark's not in the G10, but it's a developed nation and is an important trading partner of many European nations. So we've included it in the analysis. So developed ex-commodity pegged, the Danish kroner, which is pegged to the euro. We also have Asia ex-commodity pegged. And we have in Asia the Hong Kong dollar, which is pegged to the US dollar, and the Sing dollar, which is pegged to a basket of currencies that are not made public in terms of the weightings and the exact sizes of those weightings relative to their trading partners. In the Forex markets, commodity floating, so we're talking about floating regimes that have commodity exposure. We have our 4 that we looked at earlier that are part of the G10, but we don't call them G10, we call them developed commodity float. We have our EMEA commodity float, our Asia commodity float, and Latin America commodity float. So all of these are floating regimes that have significant exposure in their exports to 1 or 2 commodities. And then the next part of our opportunity set, the commodity pegged, we break down as EMEA and Asia. So EMEA commodity pegged and Asia commodity pegged. And we have here in EMEA all of the GCC countries, and the only Asian currency that has significant exposure to commodities and is pegged is the Chinese yuan. And we have the question mark here next to the Chinese yuan, similar to the question mark next to the Sing dollar. Why is that? Well, it's because the way in which the currency is pegged is not fully 100% aware or understandable. So for example, with the Singapore dollar, there is a basket of currencies that the Singapore dollar is weighted towards. We don't 100% know what those currencies are, and we don't 100% know what the weightings are. And that is essentially to stop speculation on the currency. The Chinese yuan is pegged against the US dollar, but it's what we call a crawling peg, in which it's not exactly fixed at a particular rate. The rate changes, so it's questionable. Again, we'll look into these things properly in video number 2, but for now, we just need to get this principle down, which is we have to start segmenting and defining currencies based on their opportunities and risk, i.e. their volatility. And by doing so, we create our opportunity set. The opportunity set is essentially working out where the opportunities lie to make money as traders. So we've got 46 currencies in total. 36 of them are floating, and 10 of them are pegged or fixed regimes. So this potentially limits our opportunities to 36 currencies in the market, because the pegged or fixed regimes mean that the currency value is controlled by the central authorities within very tight specific ranges. What do we mean by that? Well, the central authorities themselves intervene in the currency markets, and they make sure that their currencies stay at a certain value. Now, as we talked about earlier, with asset prices staying at the same price, we use the euro-dollar example. If an asset price stays at the same price constantly over any time horizon, So 1 day, 1 week, 1 month, 3 months, 1 year, and we buy and sell that asset at the same price all the time and pay to do so, we simply can't make money because there is no volatility. This is the same situation with pegged or fixed regimes because they stay at the same price every day, every week, every month, every 3 months, every year. Therefore, we know as traders there's no volatility and no opportunity to make money. Unless, of course, the central authorities decide not to continue intervening in the currency market. But as traders, we're not going to, for example, sit here for 5, 10, 20 years and just watch a currency every day trade at the same price, waiting for something to happen. We need to just segment by volatility and opportunities and focus on where the opportunities are on a consistent basis. So what we find is that out of these 36 potential opportunities, 17 of these opportunities are floating currencies that are ex-commodity floating. So they're non-commodity currencies, meaning the countries don't have significant exposure in their exports to one or a multitude of global commodity prices. 19 of the floating currencies, 19 of these opportunities are what we term as commodity currencies. So the countries have got significant exposure in their exports to one or two commodities. What we also find is that 4 of the currencies have significant commodities exposure. So the ones that do have that exposure are G10 currencies. So G10 as defined by investment banks and retail brokers. So they're developed. They're quite large economies. All LATAM currencies, Latin America currencies, they're floating, and there's the Latin American countries. There's no Latin American countries that don't have significant exposure to commodities. The only EMEA countries that have pegged or fixed regimes are GCC countries. And we also find that Denmark is the only developed economy with a pegged or fixed regime. And the DKK, the Danish kroner, is pegged to the euro. What else do we notice about our opportunities when we segment in this way? Well, we find that the Hong Kong dollar and the Singapore dollar are the only Asian currencies without significant commodities exposure. So they're pretty diverse. The only ones that without significant commodities exposure that actually have a pegged or fixed regime. The Chinese yuan is the only commodity exposed currency that has a pegged or fixed regime outside the GCC, and that's pegged to the US dollar. And the Sing dollar and the Kuwaiti dinar are the only pegged or fixed regime currencies that don't disclose the weightings of the currencies they are pegged or fixed to. So here we've got our 36 currencies, our 36 potential opportunities, and we've put them all on the same page here, so it's easy for you to view. Here we've got Forex markets floating. Well, that's actually non-commodity floating. So what we've defined as floating regimes that don't have significant exposure to commodities. And then we have Forex markets commodity floating. So these are our 36 opportunities. And these are the ones that we're going to basically have to not consider as volatile opportunities. So we have here the ex-commodity pegged, which includes the Danish kroner, the Hong Kong dollar, and the Sing dollar. And the commodity pegged currencies. So these are the ones that are not going to move. There's no volatility, or volatility is extremely small. Another way in which participants, so conflict of interest participants in the Forex markets, segment currencies, is you will find brokers, investment banks, media outlets, so television, newspapers, online media, everything tends to get quoted against the big currencies. And the generic one is against the US dollar, because the US dollar is the world's reserve currency. So what you're going to find a lot of the time is everything is quoted against the US dollar, or it's quoted repeatedly against the US dollar. So, or by default. So the currency cross or pair that's generically quoted against the US dollar is called a dollar cross. And that can be any currency in the world. So let's have a look at one now. The Russian ruble, for example. At the time of writing, the Russian ruble was 62.35 to the US dollar. And the way you read that is $1 US equals 62.35 Russian rubles. So $1 buys 62.35 rubles, or it takes 62.35 rubles to buy $1 US. The dollar majors are termed majors because it's all the major currencies quoted against the US dollar. And these make up 85% of daily transaction volume in the Forex markets globally. And when you look at the major currencies, so we look at Euro, Yen, Sterling, Swissy, Canadian, Aussie dollar, Hong Kong dollar. When you look at the major currencies against the US dollar, these are the ones that make up the vast majority of daily transactions. And what you're going to see is a table quoted on all media outlets. So whether it's on television, on financial news channels, where you have the ticker dropping across the bottom of the screen, or whether it's online, or whether it's in the newspaper, you're going to see a table of cross rates, so currencies that are quoted against the US dollar. So we call these the dollar majors. And we're again falling into the trap here as retail traders. Again, we're falling into this trap of segmenting currencies by the size of the economy or the size of the transactions that occur. And we have to be very careful, because what really matters, obviously, is, as we've pointed out, the volatility of these currencies. So you can see, for example, in the table here, this is every currency that's quoted against the US dollar. These are known as the dollar majors. Cross rates, specifically cross rates, are defined as the currencies that are not quoted, the cross rates that are not quoted against the US dollar. Cross rates are quoted as the majors against each other. So, for example, we have here the Canadian dollar quoted against the rest of the major currencies. So the Canadian dollar here buys 95.859 Japanese yen. And this is the table, when you combine the whole lot, this is the table that you're going to see all the time in general media outlets, the dollar majors and the cross rates. But we know better now. We know that when we see this, this doesn't mean what we're looking at is a table of opportunity. The table that we're looking at is just major currencies against the US dollar and against themselves. And that doesn't necessarily equal volatility, opportunity, and risk. So we segment in a different way. As professional traders, we have to segment based on what the currency is dependent on and what regime the currency is part of. That's the first step we take. So we're going to build this out further as we go through the video series, but we've taken a very important first step in defining exactly how professional traders group their currencies, and those groupings are based on the principle of seeking out volatility, so opportunity and risk. So we've taken that first step. We'll build out further, and what we have to do next is go to video number 2, and video number 2 will be concentrating on really understanding the differences between Forex regimes, so the fixed versus the floating regime. Before we move on to video 2 though, I'm going to go, let's go over to the trading desk for a quick summary, and then we'll shoot over to video number 2 and continue to build out this foundation. Okay, so welcome back to the desk. What you just saw there was the first real step to understanding and getting a foundation in the global currency markets, which is actually to look at the opportunities, the opportunity set that the global currency markets present to us as traders. And that first step is really understanding definitions. When you see, for example, as a retail trader, a daily rundown sent to you by a brokerage company or a media company, like on television or in a newspaper or even online, what you'll find is that all of these people, all of these companies, they group currencies based on these popularized and predetermined definitions. And what you saw on the computer screen was an example of how they all do this. So grouping all of the dollar crosses into one area, grouping all of the non-dollar crosses, so the euro crosses, the yen crosses, the sterling crosses, all into one area. And it's all really predetermined by the size and geography of the countries and currencies themselves. So big countries are put over here. So big countries against the US dollar, big countries against each other. And as a retail trader, you get hammered all the time with these definitions. And it's actually the wrong way to look at things, as we discovered. And the way professional traders look at things is they actually start splitting up things immediately into definitions which perpetuate a definition that is anchored to volatility. And the first step we took there was to look at the different regimes and look at what the currencies are actually connected to. So we're not really caring about the size of the economy at the moment. We're not really caring about the geography. What we're caring about is what regime is the currency, and is there an opportunity there? So fixed or floating, and are they connected in any way to a commodity or maybe two commodities? And we do that because volatility is subjective to the concentration of being exposed to one or two or a multitude of factors. So what we did was we split up the 46 currencies that we have available there in that opportunity set, and split them up in a way that defined them by potential volatility. Now that's just the first step. We're going to move on as we progress through foundation into defining these currencies further on a volatility basis, not on a size of the economy or geography basis. It's very key to understand that everything we do as professional traders needs to be focused on capturing volatility. So we will build this out further, but for the moment, just take the basic principle as professional traders have to capture the volatility. So we've taken the first step. So we've defined the opportunity set and defined the definition. The next thing we're going to do in video 2 is really understand the difference between fixed and floating regimes. You need to understand the history of Forex and get a really strong foundation of the differences between fixed and floating regimes. So I'm going to see you back at the desk in video number 2, and we'll look at those differences in great detail.